Hi everybody, this is Jeremy again. Okay, so today this is a very important video. We're going to be talking about the difference between an ordinary income loss and a qualified income loss. Okay, first, what is ordinary income? What is qualified income? Ordinary income is passed through to your personal tax return. Generally, this is the highest tax rate that we're going to be dealing with. The second type of income, and this depends on the security type now, as well as the holding period, is qualified income. Qualified income is discounted, whereas your federal rate for ordinary income might be 37%, your federal rate for qualified income might be 20%. Okay, so there's a substantial tax break between ordinary income and qualified income, and that's why you see the difference in the tax rates displayed here. What we're looking at is 5,000 shares of SPY. So the first consideration you're going to need to make is the income considered ordinary? Well, that depends on the type of security. I've created little information boxes here where you can read a little bit more about this and the rates that we assume for these various income amounts. And you can click through to an article that I've written that goes into detail on, ordinary income versus qualified income taxation. I encourage you all to read that article. But for the sake of this video, I'll briefly explain it to you. So fixed income, REITs and MLPs generally pay ordinary income. Now, you're going to have to do your homework here because there's some outliers where that might not be the case. But generally speaking, if you're dealing with, for example, a fixed income investment fund, that income that is paid from that investment fund is going to be considered ordinary, and there's no consideration for how long you hold that fund. It is always ordinary. Okay. The second type of income is qualified income. Well, what is that? Well, that again depends on the type of security that you're dealing with. When you're looking at corporate issue equities, generally there's some double taxation that goes on here because the corporation pays tax. For example, IBM pays tax. And then on an after-tax basis, they distribute these dividends to investors, and the government recognizes the income's being taxed twice. So instead of hitting it twice at sort of an ordinary rate, they give you a discounted rate. Now, in order to qualify for the qualified income, there's a holding period. You have to hold the security for at least 61 days or longer to be entitled to qualified income. Okay, so right now we're dealing with SPY. Well, SPY holds a basket of S&P 500 stocks. These stocks are all, you're entitled to receive qualified income for these stocks. However, you have to hold this security for at least 61 days. So again, ordinary income comes into play here, right? If I'm a swing trader and I'm going to hold this security for 20 days and receive the dividend, well, then I need to go with the ordinary income loss, right? Because I'm not meeting the holding period required to grant me qualified income tax privileges. However, if I'm an investor, I'm a little bit of a longer term holder, and I know I'm going to hold this security for 61 days or more, then I want to be using the qualified income tax laws. Okay, does that make sense? So if I buy this security and I'm holding it for 20 days and I receive the dividend, I'm going to be looking at a potential ordinary income loss of $2.4 thousand, $2,400. Okay. However, if I plan on holding the security for longer, and I don't know how long you're holding the security, that's why both of these are listed here, right? I don't know your holding period. However, I'm an investor. I'm going to own this security for 61 days or more. Then the risk I want to analyze is the qualified income loss, which is $1,300. Does this make sense? If not, please click through and read the articles that we've written on this. Again, it's really important to know this. You need to understand the security type. You need to understand the character of the income that's paid from these various security types. And you need to consider holding periods if the security you're analyzing is entitled to, if you're entitled to receive a qualified income taxation. Okay, one last thing, just so we're clear, okay? The other thing I don't know is your actual tax rate, right? I don't know what state you live in. I don't know what your income is. So I don't know what your tax rate is. Most of the time, the SEC wants you to show sort of max federal tax rates in prospectuses and so forth. So that's what we've done here. So for ordinary income, we are assuming 37% rate. And for qualified income, we're assuming 20. Now, you might have state tax in addition to the federal tax. Your rate might be lower, but provided with a tax rate of 37%, if you are at a tax rate of 30%, state and federal, you simply divide one into the other and then multiply that by $2,400, and that will give you your actual tax rate adjusted for your actual tax bracket. We're going to work to put in some custom tax rates here for pro members, but for now, just know that we're assuming a maximum tax rate for ordinary income of 37% and a maximum tax rate for qualified income of 20%. Thank you so much. Hope you like this video. Hope it makes sense. Please subscribe to our YouTube channel and ring the bell so that you can be notified as we release new tutorials, new products, new functionality. Thank you so much.